Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about inventory and cost of goods sold. This is a continuation from Chapter 5 when we discussed merchandising businesses and how to record merchandise transactions. And we're going to take a deeper look at the products that we sell in our merchandising business and also cost of goods sold. How do we track cost of goods sold? And how are the cost of those goods sold calculated? How is the value of inventory calculated? We're going to talk all about that today. As we're talking, we are currently in week 3 here at UDC, and I want to call your attention to the classroom, which is now back up and running. Uh, Under the content area in the classroom, we are currently in week 3, and in module 1 included weeks 1 and 2. Now remember, as you're in the classroom, open everything. Please open everything and do everything in order. Do everything in order. Uh, Module 1 covered weeks 1 and 2. Module 2 covers weeks 3 and 4. Each week has 2 modules, right? This is an 8-week course, as you recall. So we just covered Chapter 5. We're now going to cover Chapter 6. The PowerPoint presentations, your homework assignments, all of those are in every respective week. So please make sure that you're on track and you're doing everything on time. Very, very important. Okay, because otherwise what happens? You fall behind. Now all of a sudden you've got all these assignments. Now you're in trouble of failing, right? Please don't let that happen. Okay, let's go ahead and get started with Chapter 6. Okay, inventory, as you recall, are products available for sale that the merchandiser has. We've been using the example of Macy's. We'll continue with that example. And we'll also probably have a couple of others. We'll have great conversations like we always do. Cost of goods sold is the cost of the inventory that we sold to our customers. And let's talk a lot about our inventory. How do we identify the value of our inventory that we have on our books? And what does that value mean? What does it tell us? Because when it comes to tax time, we need to report the total value of our inventory that we have on hand. And there's a couple of ways of calculating the value of the inventory. Uh, and we'll also talk about a couple of ratios and what those ratios tell us. And so for most of this, we'll also be using the perpetual inventory system and the periodic inventory system. The perpetual inventory system, as you recall, represents the continuous updating of inventory records as it's being sold or as it's being purchased. The periodic inventory system, as you recall, represents the physical count of inventory at the end of the accounting period. Both by which have inventory values. We'll talk a lot about that. So in order to understand our inventory, we need to understand all of the related costs associated with obtaining that inventory. And the costs associated with obtaining the inventory is the purchase price of the inventory itself, the goods in transit, goods on consignment, goods damaged or obsolete, cost of insurance, postage. There's so many different costs associated with inventory, and it represents the total cost of the inventory, and we'll talk a lot about that. When goods are in transit, it means the goods are being shipped to the buyer from the seller, right? And we talked a little bit about this in the previous chapter. The first one is free on board shipping point. And that means that the buyer is responsible for the payment of the inventory that's being shipped. Free on board destination means the goods are included in the buyer's inventory after the arrival at that destination.
Dr. B?
Yeah, go ahead. Nassim, please.
Okay. The previous chapter, it has 2 points saying that the buyer on the FOB shipping,
Mm-hmm.
the buyer accepts ownership and the buyer pays the shipping.
Correct.
On FOB destination, the seller pays the shipping and also takes the risks of the loss in transit, correct?
That's correct. Yep. And
The question,
go ahead.
go ahead.
I'm sorry. Yeah. So it
No,
relates back.
continue. Then I'll have a question.
Sure. It relates back to who's ultimately responsible for that inventory while it's in transit, and that's what these two concepts represent. So, free on board shipping point says that the buyer is responsible while it's in transit. Free on board destination means that the seller is responsible for the inventory while it's in transit. And if, but as you would expect, in most cases, almost all cases, the buyer always pays for the shipping cost. The difference is how. So, free on board shipping point, the buyer's paying for it uh, through 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 the journal entry. They pay the postage directly, right? So let's say UPS is the shipper, right? Between the buyer and the seller. The buyer pays UPS for the shipping when it's free on board shipping point. The difference here is that the free on board destination, the seller is paying for the shipping, but the buyer's ultimately paying for it because it's included on the invoice. If that makes sense.
Yes.
Right.
My question is there a hybrid
Is there a
in
hybrid?
terms of
A mix between
major
the two?
companies where there's an agreement where the buyer pays for the shipping,
Mhm.
but the seller takes the risk of loss in transit,
Yeah, probably.
or vice versa?
Probably. Yeah. The answer is probably. Yes,
How
Yes,
would you
that exists.
yes, yes, it
how would you
does.
write
Because
that on a how would you write that on an account statement? Because it sounds like if I put FOB shipping, excuse me, if I am the buyer, so
Sure.
let's say I am the buyer, the company, and I buy product X,
Mm-hmm.
and I put FOB shipping, that means I'm gonna take into account expenses for freight.
Sure. Yep.
If it's a hybrid, though, I would have to put something along that line, because if, let's say, the train got into an accident and all of my um, cargo went away,
Mm-hmm.
it got destroyed. If the seller's taking the risk and I put FOB shipping, I have to put something to recognize that I could write that off right away rather than write that off
Correct.
at tax time, correct?
That's correct. And
So that can happen. I just need to note it on the account.
yeah, so it needs to be noted, but there are other options rather than FOB shipping and FOB destination, and oftentimes, like you said, it'll be noted on the account. But there's another term. The term escapes me right now, but it's not FOB at all. It's typically uh, it denotes the party responsible. It'll say something to the effect of buyer shipping, seller shipping. It's just a matter of
Okay.
term, right? Yeah,
Professor, also,
Marina.
keep in mind that there's also a contract too that goes with it. So if it's a binding
Yes.
contract and there's something like a how do they call it, like a paragraph in the contract saying if the item for whatever reason in transit is if it's damaged or anything like that, usually it'll say there like who's either if they're responsible or not, or no party is responsible, something like that
That's
in
right.
that contract itself. So
You're 100% right on that. Yep. Go ahead, Mark.
Basically what everybody's, it brings up a point because I used to work for UPS. If anything was damaged that it was the UPS fault, they'll issue you it's like a claim. You have to put it in.
It's a claim.
So,
Yeah.
so let's say for instance, I'm shipping Professor some boxes and the boxes got lost in transit. He would then call the UPS, the main headquarters, put in a claim, and then we'll issue him the refund or it's like a claim. So it's like it's like a paper trail. That's
Paper trail.
basically
Yep.
what it is.
You're right.
It's basically saying that, okay, we shipped the boxes to him, the boxes got lost in transit, or the boxes got destroyed or damaged. We
Mhm.
would then issue a refund to Dr. B because of the stuff got lost.
That's right. Yep. And so going back to what Marina and Mark had both mentioned is yes, and all of that would be expressed in the contract typically. Great questions. Yeah, good discussion. Good stuff. Couple more terms. Goods on consignment. Now, I don't know about the rest of you, but I like consignment shops. They're pretty cool. You know, you find some real interesting stuff in those places. And some of you may have shopped in what we call a consignment shop. Consignment is an interesting concept. It's where the seller provides the goods to the buyer on consignment. What consignment means is that the seller will not get paid until the buyer sells the product. So, in other words, let's say I own a consignment shop, I'll have a seller will give me the merchandise to sell. Okay. If I don't sell it, the seller will take it back. If I do sell it, then I got to pay the seller. And so basically, it's like saying, here's my goods. I'll let you sell them. If you don't sell them, you give them back to me. That's called consignment. The consigner is the owner of the goods. The consignee sells the goods on behalf of the owner.
Can
is
you
this
repeat that? What the consignment is?
Yeah, sure. Yeah, I'll repeat it. So consignment, it's where the seller of the goods gives, not sells, gives the buyer the goods to be sold to their respective customers. The buyer will only pay the seller when the buyer sells those products on behalf of the seller. So think of it like an intermediary.
so kind of like Amazon, for example, correct?
Kind of in a way. So
So,
like
sir, is this like a thrift
it's a thrift
like
store.
Plato's Closet where you take your clothes in and you give them the
Yes.
clothes, and if they sell them, then they cut you a check, and if they don't sell them, you can come get your clothes back
You got it.
or donate them?
That is 100% correct. That is a consignment shop.
Okay.
Plato's Closet, whatever the name is. Yes, it's like that. It's just like that. So it's a place where you could bring stuff. If they sell it, they'll give you what they sold it for. If not, then they'll give it back to you. Consignment. That's what consignment is. Yeah, it's a cool process, and it's just an interesting process. But of course, we have to account for stuff like that. So the merchandise is included in the inventory of the consigner. That's the consignee never reports the consigned goods in inventory. So what that basically means is Plato's Closet is not going to put your stuff in their inventory because it's not theirs. It belongs to you. It's in your inventory. And then when Plato's Closet sells your clothing, then they'll take it out of your inventory because you no longer own it, and the consignee, Plato's Closet, pays you for your sold inventory. So think of it like a intermediary. What about damaged or obsolete goods? Oh man, damaged goods or obsolete goods. They're not reported in inventory if they cannot be sold. I'm not going to carry stuff in my inventory I can't sell. That doesn't make any sense. I'm not going to pay for stuff I can't sell, right? So damaged means it's damaged. It's totally broken. I can't sell it. Obsolete means that is super freaking old. It's way out of date. I can't sell it. It's like saying, hey, we're on iPhone 30 or whatever number we're up to these days. And I got iPhone 11. I'm not going to be able to sell 11 when we're on 30? Come on. So it's obsolete. It means I can't sell it. I mean, you might be able to.
Yeah, I remember I had something like this happen to me. I was trying to give something to the Salvation Army. It was one of those tower computers, like the actual towers, and they're
Sure.
saying sorry. Um, it's they took the tower, but when it came to the monitor, because it was one of those monitors that has the back part to it,
The big
they
heavy
were
ones?
saying, yeah, they were saying sorry, it's obsolete, like we can't accept it. So
Yeah, there's certain things
even
that,
though it still worked.
yeah, there's certain things, it's so old, it's like, no one's going to buy this. Yeah, that happens. That's what obsolete is. So old, nobody's going to want to buy it. Yeah. And that's with like common stuff. We're not talking about antiques. People buy antiques, especially if they collect them. But nobody's collecting computer monitors last I checked. Okay. Damaged or obsolete goods can be sold or included in inventory at net realizable value. Net realizable value is a new term for you all, so let's observe this. Net realizable value means the sales price minus any selling costs. Sales price minus selling costs. Selling costs include things like uh, sales, salaries, selling related expenses. What do they call commission? Yeah, sales commission. Loss is recorded when there's damage or obsolete items in inventory. Now let's get into the nitty gritty, the fun stuff. How much inventory? What is the total cost of inventory? And we've talked a little bit about this, but we'll get into deeper detail. Inventory costs you money. Obviously, you got to get it to you. You got to store it somewhere. There's probably some insurance, and there might be import duties. Let's talk about all these things. Total inventory cost equals the inventory cost minus any discounts that you got when you purchased the inventory, plus all other costs. Other costs include things like shipping, storage, insurance, import duties. Shipping, we all know what that is. That's the cost of getting it transported to you. Storage, your warehouse costs something, right? You probably got to pay rent on your warehouse, so that's storage. Insurance. Insurance, as we all know what insurance is, hopefully. Insurance means that the items that you purchased are insured. That insurance simply means that if your building blows up, you might be insured. Okay. And the insurance company will pay the value of the loss. That's insurance. And there's a small cost with getting insurance on products. Then we have things called import duties. If you're importing, that means that you're purchasing a product from another country. You have to pay what's called import duties. That's import. A duty is a fancy word for taxes. Okay. You have to pay a tax on top of something that's being imported into the country. Not always, but most of the time. So all of those things
Professor,
together equal the total cost of inventory. Yes, go ahead, Mark. I'm sorry.
can you repeat that again? So you gotta pay, like if I went to Jamaica and I wanted to buy some liquor, that's import duties?
Oh yeah, yeah. Most of the time, yes. So an import duty is basically a tax on anything that comes into the country from another country.
Oh, I did not know that. Thank you for that information. I did
Very
not know
well.
that.
It doesn't happen all the time because sometimes, Mark, you can buy things from places called duty-free shops. They call them duty-free shops. So those of you who have traveled outside the country, you probably know what a duty-free shop is.
Yeah, I remember going to Japan. I didn't realize till the last day that I actually didn't have to pay taxes if I had something to go there with tax free. So,
That's right.
but next time.
Yeah, I've been to a couple different countries where, well, even here in the U.S., we have a couple stores called duty-free stores. And for those of you who remember, I lived in Hawaii for almost 10 years. And in Hawaii, we have a lot of guests from Japan and from multiple countries throughout Indo-Asia. Okay. And, a lot of Polynesian, a lot of Asian, people from all over come to Hawaii. And we have stores called duty-free stores. And a duty-free store is it's a territory where you go into the store and you don't have to pay taxes. You don't have to pay the import tax. So it's nice. It's nice. Happens from time to time.
I have another.
Professor,
Oh, too
I
many
know
at
in a
once.
lot of commercial, I guess, like these pieces beat those import tax you're talking about. Like, so if a whole car has an import tax, if they ship it in pieces, it doesn't have the same tax.
That's correct. Yeah. So yeah. So that's a way of getting around it. So what a lot of auto manufacturers do from other countries, like let's say Toyota, for example. Toyota is a Japanese auto manufacturer. They have plants here in the United States. They ship the parts from Japan to the United States and assemble the vehicle in the United States by putting all the parts together. In that process, what they're doing, well, there's multiple reasons why they do that, but one of the reasons is to avoid that import duty. Yes, that does happen. It's actually pretty cool. Okay, let's get off that topic. We got so many other things to cover. That's just one small part. Internal controls. How do you track your physical inventory? Well, there's barcodes on pretty much everything now, so that takes a lot of the struggle out of things. But we also do this thing called physical counts. These are audits. So think of a retailer like, Macy's. So let's say we're Macy's. What we do is, we have a perpetual inventory system. We have barcode scanners. We scan stuff in when we purchase it. We scan stuff out when we sell it, right? It goes through the register process. But once a year, typically, we'll close the store down overnight. We'll have a bunch of employees in the store overnight, and we're going to do a physical count of the inventory. What that does is we're verifying that our inventory system is accurate. It's an audit, yeah? We're physically counting the inventory on the shelf to match what we have in our inventory system. If there's a discrepancy, that means either it got lost, it got stolen, it broke, whatever, something happened to it. We need to make adjusting entries at the end of the year to account for those differences. So we have this inventory tracking system. And so we use perpetual system, but we also do a physical count once a year. Most companies do this. And that's to validate what they have in their inventory is accurate. Okay, now the fun stuff. Oh my goodness, here we go. Okay. We're going to use a couple different company examples, but they're all retailers, but they're different in nature. Here we go. When you have a company that sells inventory, you will use one of these four methods to assign cost to your inventory, which ultimately goes to cost of goods sold. One of these four, and here they are. One is called specific identification. This one's rarely used. It's typically only used by companies that sell specific products infrequently using the periodic inventory system. An example of that would be an auto retailer, someone who sells cars. Okay, they use specific identification. The identification number is the VIN number on the vehicle. The second is called first in, first out method. First in, first out. Okay, I want you to think of the physical flow of products. The physical flow of products. First in, first out. The first batch of inventory I ordered is the first batch I'm going to sell. First in, first out. Examples of companies that use the first in, first out method would be grocery stores. The reason why grocery stores would use the first in, first out method is because most of their products that they sell are perishable. It means they go bad, right, over time. First in, first out is used primarily by grocery stores and other types of businesses that sell perishable products. Don't worry, we'll talk in detail about all of these, but I just wanted you to understand how they're used, which type of companies use them. Last in, first out. The last in, first out method is used by about 28% of companies. These types of companies that get the product, the last one in is the first one out. Those types of retailers might be retailers of physical products that do not go bad over time. An example of that might be Best Buy. Best Buy they sell electronics primarily. Best Buy might use the last in, first out method because they don't care about the order of which they sold. Goes on the shelf, comes off the shelf, goes on the shelf, comes off the shelf. Last in, first out. And then the last method is called the weighted average. And the weighted average method, used by about 20% of companies, is they add up all of their purchases that they've made up over time. They get up the average cost of all those purchases. That's called a weighted average. We're going to talk about each one in detail. Okay, first in, first out. This is used by grocery stores primarily because they have perishable products. So in the first in, first out method, the first purchase that the company made of inventory is the first one that they're going to sell. All right. The reason for that, again, is because they're typically perishable products. So on May 1st, our company bought inventory for $45. We sold that in May. Okay. We sold that first. So that would go on to our cost of goods sold. It's $45. It's the first in, and it's the first one to be sold. So we take our total net sales minus cost of goods sold equals gross profit. The remaining inventory that we purchased in that time period goes on to, it remains as the ending inventory on our balance sheet. On May 1st, we purchased $45. May 3rd, $65. May 7th, $70 worth of inventory. Using the first in, first out method, that means I've sold the first order of inventory first. First in, first out. So the first one in was $45. So that's the first one out. Net sales minus cost of goods sold equals gross profit. The remaining inventory, the ending inventory, is on my balance sheet. So I would add my $65 purchase plus my $70 purchase, and that is the remaining ending inventory on my balance sheet, $135. That's first in, first out. Companies like Best Buy would use last in, first out because they don't care about the order of which it's sold. So last in, first out means I sell the last order that I received first. In this case, May 6th, I had inventory I purchased for $70. I would sell that first because last in, first out. Sales minus cost of goods sold equals gross profit. In this case, cost of goods sold is $70. 100 minus 70 is 30. The remaining inventory, which is inventory I purchased earlier on, is my ending inventory balance on my balance sheet. In this case, it's $110, 45 plus 65. That's last in, first out. Then we have this one called weighted average. Weighted average represents the average of all of your purchases of inventory. $45 May 1st, $65 May 3rd, $70 May 6th. We add 45 plus 65 plus 70 to get $180. We divide that by 3. Why are we dividing by 3? Because we have 3 purchases to get an weighted average of each inventory purchase of $60. Now, I sold something, obviously. So we have sales minus cost of goods sold equals gross profit. Our cost of goods sold is $60. Why is it $60? Because we sold one, and our ending balance is we got 2 left. In this case, 120 is what's left. That's 60 times 2. And that's weighted average. Now, the overarching reason why companies will select one of these 3. There's a fourth one. That's the VIN number 1. That's individual identifying unit. The reason why companies use one of these 3 is because at the end of the tax year, the company has to pay a tax for its carried inventory. And ideally, you want that to be relatively low because you don't want to pay taxes on a lot of inventory that you're carrying. And that's the overarching reason why the system's used. So if you
Professor?
yes, please. Let's see.
Okay. Given the last, I want to say chapter 4, chapter 3,
Mhm.
we're assuming that these are all the same. Like if we do either the purples, the oranges, the green, these are all the same product, correct?
Yeah, that's right.
So
Although
it
won't
looks
be.
like the product is, but okay. So, but it's sort of as the inventory is accumulating over time, the inventory is increasing in value.
That's
Although
right.
there is a chance that they could decrease in value, correct?
That's correct. Yes, and oftentimes that is the case. But
So-
this just kind of shows us that
So-
cost is rising.
So I think it's chapter 3 or 4 where we learned about depreciation.
Yes.
Could we, as another option, do appreciation?
uh,
So in other words, the May
Kind of.
1st one on May 6th, we could do an inventory appreciated versus, do you know what I'm saying? Debit Do you see what I'm saying?
Yeah, kind of, kind of. It doesn't really work that way though, because
Oh, okay.
yeah, I hear what you're
I
saying.
guess I guess we would pay more taxes then. I guess if you did it that way, we'd have to pay more taxes because now we're putting inventory at a higher cost, correct?
Almost. So here's how it works. So the business selects one of these three um, methods, right, to calculate their carrying cost of inventory. And obviously, I would, if I were the business in this case, I would select last in, first out. The reason for that is my carrying balance of inventory is $110. That's the lowest out of the three methods, at least using this example. And so, having said that, I would opt to use last and first out for this business in order to have the lowest carrying cost of inventory. Although, if it's a grocery store, they probably can't use this method because, you know, those products are perishable. But to your point, depending on the type of business, you'd select one of these three, one of the four, and then whatever's most effective for that business, tax effective, would be the best option. And in most cases, it's going to be last in, first out, but in some cases, it might be weighted average. Or in some cases, it might be first in, first out. It depends on the business and the inventory being carried. Good question. Good question.
Thank you.
Yeah, absolutely.
Thank you.
Yeah, it's good discussion. I like that stuff. Okay, the cost flow of inventory. We start each month with beginning inventory plus purchases that we've made throughout the month equals merchandise available for sale. We sell inventory throughout the month. It gets us to ending inventory plus cost of goods sold. That's the cost flow. Just a nice visual representation. And yes, it's the same thing we talked about in chapter 5, for those of you keeping track. As you recall, there are two types of inventory systems. One's the perpetual inventory, the other is called the periodic. In the perpetual inventory system, we are continuously counting inventory as it's flowing in and out of the business. The physical flow does not need to follow the cost flow in the perpetual system, although it's helpful. The balance sheet will always show you the balance of what you have in inventory. Therefore, it's the ending balance. Yeah, it's whatever's left. The balance sheet always shows you the ending balance of inventory. The income statement shows you the cost of goods sold. That's the cost of goods sold of the inventory that you sold. Yeah. And the physical flow doesn't need to follow the cost. This is the perpetual. Now, let's break down the use of the perpetual inventory system. Let's say, and let's talk about the costs as time marches on. Yep. So, on August 1st, I had a beginning inventory balance. I had 10 mountain bikes. I'm a mountain bike seller now. Okay. I had 10 mountain bikes at a cost of $91 per mountain bike. That was the cost of me, the mountain bike seller, to acquire these mountain bikes, $91 a piece. That's the beginning inventory. So I already had it in my stock. So I had $910 worth of mountain bikes in my inventory at the beginning of the month. Then on March 3rd, I purchased 15 more. I'm sorry, August 3rd, I purchased 15 more at $106 a mountain bike. Okay, yeah, so, inflation, right? Cost everything going up. So $106 per mountain bike, I bought 15 of them. It cost me $1,590. Now I have 25 units of inventory in my inventory on August 3rd. Then I made some sales. I started selling some mountain bikes over the next couple weeks. August 14th, I sold 20 mountain bikes at $130 a bike. It's not bad. It's not great, but it's not bad. Which means I have 5 units of inventory left on August 14th. I don't know why I'm thinking March. Now, okay, so I'm low on inventory, so now I got to buy some more. August 17th, I bought some more. I bought 20 more units. That time it cost me $115 a mountain bike, $2,300 total. But it got my inventory back up to 25 units in my inventory. I bought 10 more on August 28th. 10 more mountain bikes, $119 a piece, $1,190 to get me up to 35 units available for sale on August 28th. On August 30th, I sold 23 units at $150 a piece. That got me to my ending inventory of 12 mountain bikes at the end of the month. So, how do we calculate units available for sale? How do we calculate cost of goods available for sale? How do we identify the number of units sold and the numbers of units left? Units available for sale. We add up all of our purchases plus our beginning inventory. 10 plus 15, we're at 25, plus another 20, plus another 10, 55. And we have cost of goods available for sale. We add up all of our purchases plus our beginning inventory to get goods available for sale. Units sold, we add up all the units that we sold. Units left, that's what's left at the end of the month in inventory. This type of ledger it's useful because it shows us merchandise we purchased coming in and sales that we've made going out throughout them. And again, this is perpetual, so it's continuous, right? We're continually updating our inventory. Okay, so in this business, let's see here. In this business, we're using specific identification. Okay, so I guess each mountain bike's unique. Probably not what I would have selected, by the way, but that's okay. So this business likes to use specific identification. The total cost of the 55 mountain bikes available for sale was $5,990. The cost of goods sold was $4,582. We sold twice, once on August 14th and once on August 30th. How do we calculate the cost of goods sold? Well, using the specific identification model, we sold 8 mountain bikes at $91, 12 mountain bikes at $106. These are the costs, right, to us, the business. So $2,000 cost of goods sold on August 14th, plus $2,582 on August 30th, getting us to $4,582. Total cost of the 55 mountain bikes minus cost of goods sold equals our ending inventory balance, $1,408. Okay, first in, first out. First in, first out means the first one that I received is the first unit sold. This helps us to track the oldest costs and cost of goods sold, and the recent costs is our ending inventory. Recent cost ending inventory simply means that the last ones that I have purchased represent my ending inventory. So using the first in, first out method for the same company, same mountain bike company. August 1 beginning balance 910. We purchased 15 bikes on August 3. So that's your first in, right? It's at $106 a piece. First in, first in, first in. Well, technically we had a beginning balance, so that would be the first in. The first in, our new inventory balance is $2,500. First out, I'm selling my beginning balance And I'm starting to sell my first purchase from the 3rd on the 14th. So I sold 10 mountain bikes. That was my beginning balance, $91. Remember, first in, first out. I sold an additional 10 units at $106 a piece was the cost that I purchased August 3rd, 1060. My total cost of goods sold for August 14th was $1,970. We see that this is different from the individual system, which I have 5 units remaining at the August 14th at $106. Why 106? Well, I already sold my beginning inventory that I had 10 at 91. So whatever's left would be 106, obviously. And that would give me 530. August 17th, I purchased some more inventory at $115 a piece, bringing up my total inventory to 20. 25 technically. August 28th, I purchased some more mountain bikes, $119 a piece. So now I have 5 remaining when I purchased it at 106. I got 20 when I purchased at 115. And I got 10 when I purchased at 119. Then on August 30th, I made some more sales. Using the first in, first out method, I sold my 5 that I had purchased at 106 that was remaining. And then I sold an additional 18 units at 115, which is from that second purchase that I made during the month. And that's the use of the first in, first out method. Represents, that was the first in, first out. Now the last in, first out. Last in, first out shows us the most recent costs represent cost of goods sold, and the oldest costs represent the ending inventory. Last in, first out. So my most recent purchase would represent my cost of goods sold. So again, using the same data, August 14th, I made a couple of sales. Now remember, last in, first out, we're taking the most recent inventory that we purchased and selling that first. I sold 15. I sold a total of 20 bikes, right, on August 14th. 15 of those at $106. Not 91 because last in, first out means I sold what I most recently purchased first. 106, 1590. And then I sold 5 from my beginning balance of 91, 455. So my total cost of goods sold for August 14th using the last in, first out method is $2,045. And I still have 5 remaining from my original inventory, my original balance. I bought another 20 mountain bikes. I bought another 10. Then I made 2 more sales August 30th. Sold 10 at 119. Why 119? Remember, last in, first out. My last purchase was $119 a bike. And then I sold the remaining 13 at $115 a piece was the cost. And that is from the previous purchase of inventory. And that is the concept of last in, first out. Weighted average. Weighted average is the total cost of goods available for sale divided by the number of units on hand the date of the sale. On August 3rd, I had my purchase plus my beginning balance. Which got me up to 25 units available for sale on August 3rd. I take my cost of goods available for sale, $2,500, divided by 25 mountain bikes available for sale to get me to $100 of cost of goods sold per mountain bike. In this case, my total cost of goods sold on August 14th is $2,000. That's the easiest one to do, right? Okay. August 17th, I made an additional purchase. At the end of August 17th, I had 20 mountain bikes plus the 5. I made 2 purchases on August 17th. Or no, I'm sorry, I had 5 remaining plus the purchases, so it's 25 units, 2,800 total inventory divided by the 25 bikes gets me to $112 weighted average cost at August 17th. And the process continues like this. August 28th, I had 35 bikes. Total cost of inventory at that date was $3,990, giving me an average cost per unit of $114. Pardon me. Total cost of goods sold for the month was $4,622 using this method. The inventory balance at the end of the month was $1,368. So the cost of goods sold for August 30 is $2,622. We got that. We had the 23 mountain bikes, right, at an average cost of $114 per unit. How $114 per unit? That is the average from the purchases. Okay, pardon me. Goodness, throat's getting scratchy again. Okay, let's analyze the inventory. So first in, first out, last in, first out, weighted average. These are the 3 most commonly used methods for calculating the cost of inventory. The ending inventory is the approximate cost for first in, first out. Last in, first out, it's the cost of goods sold is on the income statement, approximates the current cost. This is just kind of summation, right? So first in, first out, remember, it's the first batch that comes in is the first one that we sell. Last in, first out, the last batch that we purchased is the first batch that we sell. And the weighted average is the average of all of the inventory added up together divided by the number of purchases. And we can see the impact on the income statement based off of the 4 methods. And so based off of these 4 methods, we see what the impact is on the net income. Because we see that the cost of goods sold is going to be different for each method based off of the method that you're using to calculate your inventory. And by looking at this, we can see what the total impact is on net income. Now, if my objective is to have the highest net income, then first in, first out method for my company would be the best one to use. If I'm looking to have a lower net income for tax reasons, the last in, first out method would be the best one to use. The IRS, our best friends, right? The IRS requires that when you're using last in, first out method for tax reporting, it must be used for the financial reports. Makes sense, because you use the financial reports to pay the taxes. Oh, okay. Another method I want to show you. This is called the lower of cost or market amount. Lower of cost or market amount. Are we over time? Yeah, by a few minutes. Sorry. Oh my goodness. I think we're close to done. We're almost done. If you have to leave early or on time, no worries. The recording will definitely be posted. Everyone, I apologize. We're a couple minutes over. Thank you for letting me know. Appreciate that. For the inventory that must be reported at the lower cost of market is lower than the cost. What does this mean? Lower of cost or market. The lower cost is what we want to report Otherwise, we use what we call the market rate. It's called a replacement cost. And what this tells us is the lower of the cost or market, it represents or what we call a replacement cost, which has to do with replacing the value of that inventory. Oftentimes, this type of method is used by car dealerships because it is more beneficial to use the lower cost or market rate when we are talking about assets available for sale like automobiles. Automobiles are the most commonly used asset or inventory that we can easily compare the cost and the market rate. The market rate is what the open market is saying the value is for those automobiles. And the cost is the cost to the dealership to purchase. And for reporting purposes, we take the lower of the two, right? The lower cost or market rate. That's the lower of the two. So looking at this example, we have a Roadster and a Sprint car. The Roadster, we have 20 Roadsters available on the lot. The cost is $8,500 per piece to us. That's $170,000 total. The market value of all of those Roadsters is $140,000. The lower cost or market means which one is lower, is the one we're using for our inventory value. In this case, $140,000. The market value is lower. For the Sprint car, I have 10 of them. Cost is $5,000. That's $50,000. Market value is $6,000. That's $60,000 total market. The lower of the cost or market, obviously the lower of the two is the cost. And then we add our total together to get our total cost of inventory. In this case, $190,000. And the journal entry that we make for inventory is we debit cost of goods sold and credit inventory when we sell, and it's adjusted to the cost of market or it'll say lowest cost. It's used, but it's not as common. Effects on the inventory. Sometimes we make errors, and our inventory might be overstated or understated. If it's overstated, it simply means that we have more inventory on hand than we reported that we sold. This one's overstated. Understated is the opposite. But we can see what the effect is when inventory is either overstated or understated in value. If it's understated, that means our cost of goods sold is higher, our net income is lower. If it's overstated, that means our cost of goods sold is understated and our net income is overstated. Let's just kind of summarize it. What is the effect on the when there's inventory errors on the balance sheet? If it's understated in assets and understated in equity. If it's overstated, that means overstated in assets and equity. You don't have to worry too much about those things. Oh, the ratios. You knew this was coming. So there are a couple of ratios that we use in accounting to help us to better understand the financial condition of the business. One of these is called the inventory turnover. Inventory turnover shows us how quickly we're selling through our inventory. Okay, how quickly we're converting it to sales. So ways we can calculate that is by taking our cost of goods sold on our income statement divided by our average inventory. How do you find the average of something? We add the beginning plus the ending and divide by 2. That's how you find average, right? So the beginning inventory plus the ending inventory divided by 2 gives us average inventory. Cost of goods sold divided by average inventory is how we calculate inventory turnover. Inventory turnover shows us how effectively we're selling through our inventory. Another ratio that we use is called the days sales in inventory. This shows us how long we have inventory available for sale. Okay, how long is it sitting in our inventory? Obviously, the longer that it's in inventory is not good. That means we're not selling it quick enough. Yeah. So to calculate that, we take our ending inventory divided by cost of goods sold, and we multiply by 365 days. Look at Costco and Walmart, for example. Costco, their inventory turnover is 11.9 times, which is pretty good. That means that they're selling through their inventory quickly. Their days sales and inventory is 32.1 days. That means that they have inventory on hand for an average of 32 days throughout the year. Whereas Walmart, their inventory turnover is 8.3 days, which is pretty good. It's phenomenal, actually. But the days of sales and inventory is 43.5 days, which means their inventory sits longer on their shelves, which isn't necessarily a good thing. Inventory costs using the periodic system. The periodic system, as you recall, is when we periodically count the inventory as it's sold, right? It doesn't update automatically. It's a physical count. But the physical count doesn't need to follow the cash flow. The impacts on the balance sheet is we use the ending inventory and the cost of goods sold on the income statement. It's the same with all inventory. We see the impact of using the periodic inventory system when we use something like cost of goods, what do you call the specific identification, the first in, first out, last in, first out, and the weighted average. It's very similar in nature. The difference here is when we're allocating when we're allocating the inventory that we have available for sale. And this follows the same exact process. Using the first in, first out method, we had 10 mountain bikes, August 28th, 119, 2 August 17, 115, beginning available for sale, minus our ending inventory equals cost of goods sold. Last in, first out method, same process, right? So the last one is the first one out. Units available for sale minus ending inventory equals cost of goods sold. We know that the first in, first out, last in, first out, weighted average, or the individual system, they all have an impact on our ending inventory, which ultimately affects our cost of goods sold. That's what this shows us. Weighted average is average cost. And so that is very, very similar to what we had before using the other method. And we could see using the periodic inventory system, the impact of cost of goods sold. Cost of goods sold is impacted from the ending inventory balances. And we can see how that impacts the income statement. And in this, again, depending on the motive of the business, having a higher net income is oftentimes good, but for tax purposes, you kind of want it to be a little lower. And of course, you need to tell the IRS which one you're using. Inventory estimate methods. We estimate inventory all the time, especially if it's almost impossible to count the physical inventory. So if there's like Walmart, for example, do you think they're closing down the store to do physical inventory twice a year? Probably not. If they had the ability to, they would, but it costs them millions of dollars just to do that. So oftentimes they don't do it. So what they'll do is they'll estimate it, and there's a couple steps that we follow to get that done. But you don't have to worry too much about that. Okay, we made it to the end. Yay! Of chapter 6. I apologize that we went, looks like 18 minutes over time. I do apologize for that. Are there any comments, questions, or concerns that you have in regard to chapter 6?
Professor, I have a question.
Yes, please.
It's not exactly in regards to chapter 6. I actually
Go ahead.
work a job during the day. So
Oh,
I'm
okay.
just wondering, in the event that class goes over, if I drop off, will I lose not receive credit for attendance? Because
Yeah, so I don't actually take attendance, right? Because attendance is not a part of your well, I do, right? But
right.
it's strongly encouraged that you're in class. And I understand you're working a job, and you did sign up for a class during the time. But if we go over, I totally understand. So don't worry
Okay.
about that.
Okay.
If we end at 1:30, you gotta go. You gotta go. It's totally fine. It's not your fault. And I'll never penalize you for missing a class, or I'll never penalize you for any of that. So don't worry about it.
Okay. Thank you, Professor.
My pleasure. Um, any other comments, questions, concerns for anything? You're all good. Okay. As always, thank you so very much for your time today. I truly appreciate you all being here and asking great questions and working through all these wonderful problems. Uh, so, as always, I want you to do the usual stuff. Do your homework. This Sunday night, Chapter 5 quiz, Chapter 6 homework. I understand if it's like a day or two late. It's okay, right? Especially since we didn't have our class on Tuesday. But yeah, please, Chapter 5 quiz, Chapter 6 homework. Ideally, try to get them in by this Sunday night. If you have anything past due, make sure you get your work done. If you remember, the only way you'll fail this class is if you don't do the work. That's how you fail, right? So make sure you do the work to pass the class. It's really that simple, I promise you. If you have questions, comments, concerns, you have my phone number. Set up office hours with me. Email me, whatever it takes. I'm always here for you. In addition to that, I want you to stay safe, wash your hands, do the right things. I appreciate all of you. Have a wonderful day. Thank you so much. Bye bye.